Well, g'day the traders and friends, market enthusiasts right around the world. You are here once again with James on behalf of Pivot Point Trading as I sit down and bring you this Tuesday afternoon market recap. Some big advancements taking place, especially in terms of reversal signals. As at the close on Tuesday, Dow Jones Industrial Average closed down just over 200 points, and the majority, if not all, of the gains which we established on Monday have been given back by the market. What makes this even more important is that this is the second strongest two-day bearish reversal candlestick pattern there is in the world of candlestick patterns. It's what we call the one black crow candlestick pattern. You can see that we gapped down slightly below the close of yesterday's candle, and we actually have a long day Morobozu which closed below the open of Monday's trading session. I'm still waiting on the volume for this two-day reversal candlestick pattern, but what makes this even more significant is that it's occurring at the right location at a resistance level at 16,500. We have come up and we have retested the bottom of the red box. I'm still expecting this market to move on up into higher highs, or at least not macro higher highs, but sort of monthly higher highs, and still eyeing off that 17,000 figure on the Dow Jones Industrial Average. But with the advancement of this two-day reversal candlestick pattern, we have to change our plan in terms of analysis. Not all too much, but we just need to expect the market to pull back a little bit more until we see the natural correction and the major oscillation back up into the declining primary trend. So how is this most likely going to work out across all three of the financial markets? Well, let me zoom in and just show you this very, very quickly. As you can see, since January 2016, we've pushed down below 16.5. We've come up and retested it on one occasion just here. We've retested it on two more occasions over here, so 2 and number 3. And then most recently, as at the close today on Tuesday, this is the fourth occasion in 2 months where we've sort of pitted and patted around that 16,500 area. Now, again, I'm expecting this market to pull back before we see the advancement higher. And what level, and the level, which I'll be paying attention to very closely, is around 16,100 on the Dow Jones Industrial Average. I'm certainly not expecting this market to break below these two swing lows, these macro support levels between or in January and February, because we're simply not oversold enough, or we're not actually overbought, and we haven't gone through the natural ebbs and flows in the corrective cycle, which is what I'm expecting, again, pushing the Dow Jones up into that 17,000 figure. If I change to the oscillating indicators, you can see that we are naturally somewhat overbought. The Stokes is quite high. The RSI is turned down, but if you pay attention to the MACD, we're still not seeing really any changes in the signal line at the moment. This is obviously going to change if, in fact, we see a larger pullback, but the signal line as at the close on Tuesday, it really hasn't adjusted for this bearish pullback, which we saw again today, down 212 points. What I've been speaking about over the past couple of weeks is that you want to pay attention to the MACD and you want to pay attention to the signal which is generated when the signal line crosses the slow line. When that happens, it's going to set up a major momentum move to the downside. But what we're starting to see once again is that cycle back to the upside, and during cycles and during sort of bearish counter trend movements or bullish counter trend movements in bigger or larger primary bearish trends, things just don't go parabolically up, right? You go up a little bit, you pull back, you make another higher low, and then you make a higher high. And that's just the way that these markets move during the corrective cycles. Very rarely do you see a market just move straight up, and very rarely, unless it's capitulation, do you see a market just break support and move completely downwards. All right, you just go through buying and selling, but the overall momentum is what is most important. So although we do have, again, a very bearish day in the markets at resistance with that one black crow, and of course the continuation lower, which we are expecting, obviously in the more so the intermediate future, based on the MACD and a few other signals which we have, we're expecting this market still to put in relative higher highs relative to what we've seen since mid-January and also early February. If I change to the exponential moving averages as well, you can see that at the declining 50 exponential moving average, this candlestick pattern is showing up, and it is coinciding at that resistance level. So this isn't unexpected. Just as we've come back up and retested the 10 and failed, albeit very briefly, and come back up and retested the 20, failed, albeit very briefly, we've just come back up and we're retesting the 50 for the first time since 2015. So if I zoom all the way back out and go to 2015, and this is when the market itself was moving sideways, it's the first time that we've legitimately broken down below it, and we've had the stamina, or at least the momentum, to come back up and retest that declining 50 for the first time, as I've already alluded to. So these are just the natural advancements of the market. A lot of people, again, are really starting to freak out and say, well, is this the beginning of a large move to the downside? In my opinion, no, it's not. We still need to do something like this. We'll put in a higher low relative to the low which we established in February, and that will set up something like this around 16,000, 16,100, and then we'll get the sort of the second wave continuation higher, which will ultimately fail. So, I mean, if you're sitting here right now and you're still humming and hawing about market direction, the long-term market of the trend, and you've sort of been swept up by the bullishness or the sort of the sentiment, the bullish sentiment, which is sort of, thrown a blanket over the market over the past 6 days as the market is just seeing continuous gaps up in long day Morobozus. Just think about for a minute just how quickly sentiment changes when the market establishes one down day of about 200 points. People are really starting to worry about this market, and I can see all types of news reports right now saying, well, is this the beginning of the roll? Or is there a bigger roll coming, or is there some more lower lows to put into this market? And sentiment, again, collectively, changes very, very quickly. So you really need to remove the emotions from trading, analyze the chart, let the chart guide you, and have a game plan, have a blueprint, have a blueprint of what and how you are going to trade this market at certain levels. Now, I've been very clear about this to people of where I will personally be taking on open trades. One of those trades was at that declining 50 exponential moving average. So as it stands, I've opened up a position, and it is profitable at the moment, but I'm expecting it to move into a loss. I mean, and I'm completely happy with that. What I don't want to do is be a technical analyst or someone who follows the market very closely and miss my opportunity if in fact this is the beginning of the roll. So I've said to myself, look, the 50 exponential moving average, when we get here, I'm adding to my original shorts at 17,1026 and 17,633. And I'm happy with that, even if it results in a losing trade. The next area which I'm eyeing off will be below macro support if that breaks. And again, I don't place too many eggs in that basket, or it's going to still be up at relative higher highs compared to where we were throughout the months of January and where we are currently in February. So that's my little game plan, breaking down this market. Again, pay attention to that MACD oscillator, which really just maps momentum. Again, that signal line hasn't turned down, so it's something to think about. I wouldn't be getting carried away with this bearish move, although I can see the market itself pulling back a little bit. I'm not expecting it to break the lows. Again, it's going to set up a little relative high compared to the low, which we established in February, and this market will continue to move higher. I can say that almost definitively, or with a lot of authority anyway. But, having said that, nothing's ever 100% certain in financial markets, and you just need to learn to live with that. So, I mean, as at the close on Tuesday, that's what I'm expecting. That's what the candlestick signaled to me. But within the larger corrective cycle or the movement back into the declining primary trend, we still have a way to go in this natural dead cat bounce, sort of short squeeze higher. All right. Outside of that, friends and traders around the world, I will leave it. I hope you enjoyed your Tuesday and you're having a fantastic week. I will be back with you later in the week for more market updates. All the best, everyone. Goodbye.